Welcome to the deep dive. Okay, think for a second about institutional capital. The trillions managed by the world's biggest players, the banks, pension funds, asset managers. When you hear this massive stream of money is finally moving into crypto, what assets actually come to mind? Is it like the newest DeFi protocol? Are they secretly snapping up meme coins?
Well, historically, that might have been the initial flirtation, right?
Yeah.
Driven by the crazy volatility and the headlines that, the retail side was seeing. But what our sources are really showing now is something, well, much more strategic and frankly, a lot less flashy. It feels like a real fundamental pivot in how Wall Street is engaging.
Exactly, that's our core finding today.
Mhm.
Wall Street is moving its capital, yeah, but maybe not into the tokens you'd first think of, particularly the altcoins. They seem to be shifting away from that direct, high-risk token speculation,
Yeah.
moving much more towards getting equity stakes, pursuing IPOs in established regulated crypto companies, trying to de-risk it.
It's a classic institutional move, really. They want that potential exponential growth from crypto and Web3, sure, but they need it delivered in a way they understand. Highly compliant, auditable, structurally familiar. It's like buying the factory, not just betting on the first prototype plane that rolls out.
Okay, so that sets up our mission perfectly then. We're diving into the sources that detail this whole institutional pivot. The goal is to really get why these major financial players prefer buying shares in crypto companies, the equity, over just holding the tokens themselves. And maybe more importantly, figure out what this big strategic shift means for the market structure, for regulation, and, well, the whole story of Web3 going forward.
Yeah, the big picture is definitely a dramatic change in focus. Less chasing that, speculative 100x token dream. Instead, you're seeing enormous resources going into securing equity, getting into those big private funding rounds, and gearing up for public listings of the infrastructure giants. We're talking custodians, exchanges, the service providers, the companies that actually support the whole crypto economy. It's about owning the regulated rails, really, not just trying to jump on the fastest, maybe unregistered train.
All right, let's get right to the heart of it. This key difference between equity and tokens. For us, maybe as retail investors, tokens often feel like the main way in. But when a BlackRock or a Fidelity looks at the landscape, they're comparing the risk of a token versus the risk of an audited company share. And the difference must seem huge to them.
Oh, it's fundamentally different. Institutional money is like overwhelmingly looking for equity stakes in these crypto native companies. Why? Because that's the structure they can invest in based on their mandates. We're talking about firms providing essential services, right? Exchanges, infrastructure software, dedicated custodians for security, asset managers. The big money wants shares in these businesses, not necessarily just holding the volatile assets those businesses handle.
Okay, so why the strong preference then? I mean, if the price swings of the underlying assets are what drive the big returns, why would a huge asset manager say, look, I'd rather own Coinbase stock than a basket of different altcoins?
The answer really boils down to compliance, regulation, and familiarity. Equity gives them four things that tokens, generally speaking, just don't. You've got established regulatory clarity, universally recognized audited financials, predictable sort of traditional growth models, and a standard corporate structure. When you buy shares in a company, say a US-based crypto exchange, that company falls under decades of existing corporate law, securities regulation, GAAP accounting standards.
Right. And that regulatory and structural advantage is just massive for them. For a traditional firm, working within a known framework drastically cuts down on, well, career risk and institutional risk.
Absolutely. Investing in equity makes SEC oversight straightforward. Companies going public or even taking big private institutional money, they need audited reports certified by major accounting firms. This is like the bedrock of traditional finance. It's not just nice to have, it's an absolute legal fiduciary requirement for these institutions. Think about the CIOs at pension funds or university endowments. They need those audited reports to justify what they're doing, internally and externally, to clients, to trustees. It's just so much easier to get approval to buy shares in a regulated, publicly traded company than it is to hold some, highly volatile, sometimes opaque altcoin that might be operating in a total regulatory gray zone.
Okay, but let me push back just a little on that safety idea. I mean, buying Coinbase stock still gives you exposure to those volatile token prices, right? If Bitcoin tanks 50%, Coinbase's trading fee revenue tanks too. How much safer is it really compared to holding Bitcoin directly?
That's a really crucial distinction. Yes, the equity price is definitely correlated to the wider crypto market. The revenue depends on volume after all. But the shift reduces idiosyncratic risk. When you hold a token directly, you face the risk. The protocol itself fails, maybe the tokenomics are flawed, the developers vanish, or that specific protocol gets hit with some unique regulatory action nobody saw coming. That's idiosyncratic risk specific to that one asset. When you buy equity in an exchange or a custodian, you're betting more on the long-term adoption of the technology itself and the growing need for reliable intermediaries. You've essentially outsourced the specific risks of thousands of individual tokens to one single regulated corporate entity.
Ah, okay. So the structure itself is just inherently more Wall Street friendly because they actually know how to model corporate risk.
Precisely. For a risk committee at a major bank, buying shares in a company like, say, Galaxy Digital just feels fundamentally safer, more understandable, than grappling with holding a pool of volatile tokens, maybe even staked somewhere or used in some new DeFi thing. They know how to value equity. They use recognized metrics, EBITDA, revenue projections, cash flow analysis. It's familiar territory.
Which brings us right to the focus on business stability. Institutions aren't really interested in a business model that just relies on the price of one speculative asset going up and up. They want fees. That's stability in finance.
That's exactly right. They are specifically drawn to stable business models. They want firms generating revenue through traditional, ideally recurring streams, transaction fees from exchanges, service charges for custody, maybe subscription fees for infrastructure software, providing verified blockchain services. This revenue stream is generated beyond just the raw token price swings.
So if you're an exchange and you charge, let's say, 10 basis points on volume, it doesn't matter if Bitcoin is at 20K or 60K. That volume-driven revenue is something traditional investors can actually model. They can value it using a familiar price-to-earnings ratio.
Yeah, it gives them a predictable investment thesis, something that speaks the language of traditional finance. They're betting on the long-term sort of secular adoption of digital assets and the growing need for compliant middlemen, rather than just betting on one token succeeding over another. Compare that to valuing a token that involves complex tokenomics models, assessing governance risks, predicting network adoption, all very specialized non-standard metrics. Equity investing, relatively speaking, is a well-understood formula for them.
Okay, so this shift isn't just theoretical, right? It's backed by some massive real-world deals and milestones. I guess the genesis moment, the real kickoff for this institutional pivot, has to be the Coinbase listing back in 2021.
Oh, that was truly seismic, and partly because of the mechanism they used. It wasn't a traditional IPO, remember? It was a direct public offering, a DPO. But its significance for Wall Street was identical. It was the first chance for traditional finance players to get regulated, large-scale exposure to the crypto ecosystem through the equity market.
And the institutional hunger was just ferocious, wasn't it? Even with all the market volatility that year. At its peak valuation, Coinbase hit something like $86 billion. I mean, just to put that in perspective for you listening, that valuation was higher than many major U.S. financial institutions, even some traditional exchanges at the time. That number alone just shows the sheer institutional demand waiting to get into crypto, even if they weren't buying Bitcoin directly themselves.
Yeah, it set a critical precedent. It proved two key things. First, that a crypto company could actually meet the really stringent regulatory and public reporting hurdles the SEC requires. And second, it proved there was this massive investor base, starved for compliant ways to get involved, just waiting to pour institutional capital into these equities. The DPO essentially formalized the crypto infrastructure asset class.
Okay, now let's talk about a sector that's under even more intense regulatory heat, stablecoins. The IPO ambitions of Circle, the issuer of USDC, that seems to further highlight this move towards legitimacy via equity.
Right. Circle's persistent attempts to go public first with a SPAC, then aiming for a more traditional IPO that's highly significant. A successful IPO for a major stablecoin issuer would arguably be the single most important step for stablecoin legitimacy within traditional finance. It forces transparency on the reserves, which is obviously crucial. It subjects the whole operation to public reporting, and it gives the SEC and other regulators a clear, audited corporate entity to actually oversee.
So it changes the stablecoin story from potentially a high-risk, maybe unbacked asset, which is how some regulators saw them initially, to a transparent, regulated financial service provider that makes money from fees or managing reserves.
Precisely. Filing for an IPO means you have to clearly disclose your management team, detailed financials showing how you make money, and explicitly list all the risk factors, especially around regulatory changes. That level of detail is exactly what institutional compliance teams need before they can sign off.
And we also have examples of early regulated exposure through firms like Galaxy Digital, right?
Yeah, Mike Novogratz's firm, Galaxy Digital, they got early regulated exposure by listing on the TSX, the Toronto Stock Exchange. That's often seen as a slightly more accommodating first step for novel financial products compared to the US markets sometimes. This let institutions invest in a diversified crypto finance company, covering asset management, venture capital, trading, everything all wrapped up in a publicly traded, regulated package. It was a really vital early entry point for institutions needing that legal safety net, proving crypto operations could meet public market standards outside the US, too.
Then there's the really fascinating kind of non-traditional case, MicroStrategy. It wasn't an IPO based on its crypto business per se, but its stock basically became an institutional proxy for owning Bitcoin.
MicroStrategy is like the perfect example of this powerful institutional demand for regulated access. By putting just massive and growing amounts of Bitcoin onto its corporate balance sheet, the stock, MSTR, completely transformed. It essentially became this leveraged, publicly traded way to own BTC. Institutions that might have been blocked from holding Bitcoin directly, maybe due to their charter, regulatory uncertainty, or internal rules, could just buy MSTR stock instead.
Let's unpack that leveraged part for a second, because that feels key. It's not just a simple one-to-one proxy, is it?
No, definitely not. MicroStrategy used things like convertible bonds and other financial tools to raise cash, which they then immediately used to buy more Bitcoin. So this borrowing against their existing assets magnifies their exposure to Bitcoin's price swings. When Bitcoin goes up, the value of their holdings increases disproportionately compared to their equity capital, driving MSTR stock higher faster. This leverage, but packaged inside a normal corporate stock, lets sophisticated institutional investors get amplified BTC exposure using familiar equity rails. It really highlighted that if a compliant equity product exists, institutions will absolutely use it, and aggressively.
And just to hammer home why this equity preference is so critical for traditional players, we really have to look at the painful counterexample, the FTX collapse.
Ugh, yeah. The FTX failure was the ultimate catalyst. It probably permanently cemented the institutional preference for regulated, reporting-compliant equities. The complete lack of regulatory oversight, the total opacity of their balance sheet, the internal misuse of funds, and then billions just vanishing overnight. It hammered home the extreme risk of dealing with purely token-based, unregulated platforms. When institutional compliance teams saw those kinds of massive losses coming from zero external audits and just gross internal mismanagement, the choice became crystal clear. Stick to companies that follow public reporting rules under the full glare of regulators.
The lesson was pretty stark, delivered with multi-billion-dollar consequences. Audited financials, clear governance, public oversight, these aren't optional extras for serious large-scale institutional money. They're absolute requirements. Okay, so we got the what and the why, and we've seen the proof in these case studies. But this naturally leads to the big question. If the institutional money is mostly flowing into equity, what does that actually mean for the tokens themselves? The digital assets the whole industry was built on.
Right, now we get into the core market implications. And this shift definitely creates some distinct winners and, well, potential losers among the different asset classes.
Let's start with Bitcoin. It seems to remain the primary institutional asset, kind of regardless of this equity shift.
Absolutely. Bitcoin still has its superior liquidity, its established recognition, it's the main gateway asset, and now it's often accessed via regulated products like the spot ETFs or through stock proxies like MicroStrategy. Its position feels solidified, not just as a store of value, but as a kind of compliance-friendly asset class that can be easily custodied and reported on by these big players.
But the real worry then becomes the altcoin sidelining risk. If institutions are mainly interested in regulated equity, where does that leave the thousands of smaller, maybe riskier altcoin ecosystems that really rely on direct capital flowing in?
This is where you see that structural split happening. And yeah, it's a potentially massive risk for smaller protocols. Institutions might choose to invest in the companies building on top of those altcoin ecosystems. Think about like the software firms creating specialized wallets for a particular chain, or the decentralized infrastructure firms providing compute power, or the analytics firms tracking that ecosystem. They'd rather hold equity in those companies than hold the altcoins directly. If they can get a stable, equity-based return from the infrastructure supporting the token, why gamble on the token itself? This could genuinely starve certain altcoin projects and niche ecosystems of that crucial early institutional funding they need to really scale up.
Which creates this rapidly widening gap between the retail market and the institutional market. It's almost like two parallel crypto universes are developing, defined by risk tolerance and compliance needs.
Yeah, the sources really back up this bifurcation. The retail market is still dominating meme coin speculation, diving into niche DeFi, exploring the riskiest, highest volatility corners, often prioritizing pure decentralization over formal reporting. Meanwhile, institutions are laser focused on regulated compliance friendly plays through corporate equity. They want predictable earnings from fees, not high stakes bets on the tokenomics of some new, unaudited protocol.
This strong institutional entry point, though, it does seem likely to speed up the creation of better TradFi Web3 bridges, right? Fundamentally changing how the old financial world interacts with the new one.
It absolutely does. Every single successful IPO acts like a highly formalized, sturdy, and regulated connection between traditional finance and decentralized web infrastructure. These IPOs manage to translate Web3 growth into a format that every traditional asset manager, every quant desk, every retirement fund manager understands. It's a public stock.
And this institutional demand for compliant access, it surely drives huge M&A activity too. Like, couldn't this push bigger banks and financial institutions to not just invest, but to actually buy controlling stakes in or fully acquire key custodians, regulated exchanges, or vital blockchain infrastructure firms?
M&A feels like the logical next step in this trend. If a major global bank decides it needs a top-tier custody solution that meets specific regulations like Basel III or state rules, it's often way faster, cheaper, and less risky to just buy an existing, maybe IPO-ready custodian that already has the tech and clients, rather than trying to build that super specialized, regulated infrastructure from scratch internally. This massively speeds up the integration of Web3 tech into legacy financial systems.
Which completely changes the narrative for the whole sector, doesn't it? We're moving away from seeing crypto as just purely speculative assets towards something much more financially concrete.
Yeah, the new narrative is incredibly powerful. Thinking of crypto companies as legitimate growth stocks. That's a total shift from viewing tokens as purely speculative assets. This new framework gives institutions the familiar tools for valuation. It lets them apply traditional metrics, PE ratios, forward revenue growth projections, operating margins to these companies, making them acceptable for standard portfolios. The investment argument changes from buy this token because it might moon to invest in this company because its revenue streams are tied to the global adoption of blockchain technology. That's a huge paradigm shift.
Okay, but like any major strategic shift, especially one involving billions, there are always risks, right? Even when the whole point is to de-risk things via equity. What are the main financial risks tied to this rush towards crypto equity?
Well, the first big one is inherent in pretty much any tech hype cycle. Valuation concerns. IPO-ready firms, especially those showing high growth potential but maybe low current revenue, can easily get overpriced when market excitement is high. We definitely saw that with Coinbase's initial huge valuation, inflated initial prices based on future hopes rather than solid current earnings. That creates a big risk of drawdowns if the underlying market or trading volumes don't meet those rosy expectations. You might pay for 20x revenue only to find the fee model is actually pretty volatile itself.
And even with better compliance and SEC oversight, the fundamental regulatory risks don't just disappear entirely, do they? They just kind of change shape.
That's exactly right. Even though they're seeking clarity by sticking to corporate law, the regulatory overhang is still there. The SEC or other global regulators could still heavily scrutinize new listings, particularly if the underlying business models involve things that blur the lines, like maybe novel staking services or complex crypto lending products. A successful IPO doesn't grant immunity from future regulatory shifts, enforcement actions, or just how courts decide to interpret existing securities laws for digital assets.
This brings us to a really interesting potential downside, the innovation trade-off. By demanding all this compliance, auditability, corporate structure, our institutions may be inadvertently slowing down the super-fast innovation that made crypto so exciting in the first place.
This might be the most significant unintended consequence, yeah. Focusing solely on equity and getting IPO ready inherently prioritizes rigid compliance, legal checks, stable governance, over rapid, boundary-pushing, truly decentralized innovation. The requirements for traditional reporting often clash with core Web3 principles. For example, a decentralized, autonomous organization, a DAO, might find it structurally almost impossible to produce the kind of audited financial statements needed for a corporate IPO.
Hmm. So the infrastructure gets safer, maybe slower, designed to pull in institutional money, while the most dynamic, maybe cutting-edge DeFi projects that need riskier token-based funding might just get neglected.
Exactly. That compliance hurdle acts like a filter. It favors more centralized entities that look and act like traditional tech companies. This could inadvertently stifle those grassroots projects and altcoin ecosystems that rely on open source, token-driven funding models. It might lead to a more centralized, more corporatized future for crypto overall.
Okay, this is a deep topic, but let's pivot now to giving our listeners some practical tools. If you're a sophisticated investor trying to track this shift in real time, how do you actually measure this institutional trend? We need some solid data points.
Yeah, there are about 4 key metrics from the sources that really help distinguish this strategic equity shift from just general market noise. First, you absolutely have to compare the performance of crypto equities against the underlying assets. So look at how Coinbase stock, Coin, performs versus, say, BTC and ETH prices.
Why is that comparison so critical?
Because the equity often moves differently than the tokens themselves. It reflects the company's operating performance, how well they're controlling costs, their strategic buys, any regulatory wins they have, not just pure sentiment towards Bitcoin. If Coin is doing well, even when Bitcoin is flat or maybe down a bit, that's a strong signal. It suggests the institutional market values the company's efficiency, its recurring revenue, its regulatory progress, maybe more than the day-to-day volatility of the asset price. That decoupling, that's the institutional signal you're looking for.
Okay, another key metric then tracks the preference for regulated versus just raw spot access.
Yes, monitoring crypto ETF inflows, which are essentially equity-like instruments versus raw altcoin spot trading volumes. If institutions are pouring money into regulated ETF products rather than directly trading altcoins on spot exchanges, that clearly tracks their preference for compliance and regulated access. It shows where the big, often passive pools of capital are actually flowing.
And we need to track the future supply of these equities too, right? The IPO pipeline.
Absolutely essential. You need to track the number of crypto companies filing S1 documents. And S1 is that initial registration form you have to file with the SEC if you're a U.S. company planning to go public. It's a massive document, detailed financials, risk factors, management discussion, corporate strategy. Filing an S1 is basically the ultimate, undeniable proof of institutional intent to move from private VC funding to public institutional capital. A growing pipeline signals high confidence from management in both regulatory success and market demand.
You also mentioned correlation data using heat maps. That sounds a bit technical, but potentially very revealing.
Correlation heat maps are super valuable here for forensic analysis. You compare how major crypto equities, Coin, MicroStrategy, maybe Galaxy Digital move in relation to the major tokens like BTC, ETH, and the big alts. If the equity correlation with the overall crypto market gets stronger, moves towards 1.0, it suggests the traditional market is just treating it all as one single risky sector. However, if that correlation weakens significantly, meaning Coin starts moving independently of token prices, it suggests the equities are being valued on their own corporate merits, separate from the daily token swings. That weakening correlation is the ultimate institutional validation signal, showing these are seen as standalone, legitimate stocks.
Got it. And finally, tracking the actual funding shifts.
Yeah, track how the money moves. From private venture capital raises to public IPO listings. When a company successfully exits VC funding and pulls off a massive IPO, that represents a successful transition. It's moving from early-stage, speculative, private risk capital to more stable, public institutional capital. That transition, measured in billions flowing onto public exchanges, is maybe the clearest quantitative proof of this whole pivot we're talking about.
Wow, okay, this has been an incredibly detailed deep dive into these underlying structural shifts in how big money is looking at crypto. We've gone from GAAP accounting to S1 filings. Let's try and boil this down into some actionable insights for different people listening. So if you're a trader, what should you take away from this strategic shift?
Right. If you're a trader operating more in the short to midterm, you absolutely need to watch IPO announcements and major institutional funding rounds very closely now. These events are becoming critical, scheduled market milestones. They're significant enough to actually move related markets. The sheer amount of liquidity needed for a big IPO, or just the market confidence boost it provides, can definitely impact altcoin liquidity as capital potentially shifts away from speculative pockets towards these huge regulated events. They might even create temporary ceilings in the market as investors sell tokens to free up cash for the IPO stock.
Okay, so it basically becomes a required risk assessment and scheduling event for your trading calendar. Now, what about the long-term investors listening? The ones maybe building diversified portfolios for the next 5, 10 years.
If you're a long-term investor, you should seriously consider getting exposure via equity, meaning the stocks of compliant crypto infrastructure companies as a potential core long-term play. This can act as a really vital hedge against some of the specific regulatory risks and the really acute volatility risks that come with holding tokens directly. By owning the exchanges, the custodians, you're betting on the long-term secular growth of the whole ecosystem, but you're doing it with the established safety rails, the regulatory recourse, the reporting transparency that corporate equity offers. It's arguably a less volatile way to participate in the crypto boom over the long haul.
And finally, for the people actually building the next generation of Web3, the developers, the founders, the product managers out there.
Yeah, for the builders, the institutional market is sending a really profound signal about maturity. Being IPO ready emphasizes strong governance, robust compliance frameworks, and proven scalability. Much more than just hyper-complex tokenomics. If you want to attract that long-term, multi-billion-dollar institutional capital down the line, you have to prioritize becoming an auditable, compliant business first. Your legal structure, your compliance officer, they're becoming just as crucial as your core code. The big money is clearly looking for infrastructure, reliability, and regulation.
So it's like robust governance isn't necessarily a roadblock to innovation anymore. It's becoming the prerequisite to attract the kind of capital needed to scale that innovation globally.
Increasingly, yes. That seems to be the ticket to the big leagues now.
Okay, that brings us towards the end of our deep dive. We've hopefully synthesized the key lesson here. Wall Street is embracing crypto, but crucially, they're doing it very much on their own terms. Regulated, audited, and through the familiar structure of corporate equity, they're buying the factory that builds the tokens, not necessarily jumping straight into buying all the tokens themselves.
It really feels like the pragmatic, maybe evolutionary maturation of the crypto landscape. It's kind of the difference between, private venture capital funding a disruptive, maybe chaotic startup, and the public markets funding a reliable, fee-generating utility company.
Which leaves us with our final provocative thought for you, the listener, to mull over, based on everything we've discussed today. If institutions increasingly prefer buying shares in the crypto infrastructure, the exchanges, custodians, miners, does that ultimately lead to a more centralized future for Web3? A future where compliant corporate infrastructure ends up dominating all the activity? Or does the infusion of all this stable, massive institutional capital simply provide the necessary financial stability and legitimacy for the underlying decentralized technology to finally thrive properly on a global scale?
Yeah, that choice or tension between centralized stability and decentralized freedom, that's really the core tension of this whole pivot. We'll leave you to wrestle with that one. Until next time.
Thanks for diving deep with us. We'll catch you next time.